Hey everybody, Boris with BK Forex. Welcome to the weekly technicals for September 18th to September 22nd, 2017 for the majors for Eurodollar, dollar yen, and pound dollar. And what an unbelievably interesting week we had last week with pound just blowing past the Brexit resistance at 135. BOE really coming in very, very tight. And that is really, I think, the central thesis the market is looking at right now. If there is an overwhelming, absolutely, I think, cataclysmic, tectonic shift in central banking right now, it's the fact that we are finally moving away from QE and accommodative policy to a more normalized monetary policy. And this was obvious, of course, with the Fed, but also with the Bank of Canada, as we saw, and now with the Bank of England. And even with the ECB, everybody is moving. Everybody except Japan, which I'm going to get to in just a second. But everybody except Japan is moving from wide to tight, from accommodative to restrictive, from dovish to hawkish monetary policy. I think that, besides anything else, is the central tenet of FX trading as we go forward into the fall and into the winter of 2018. So keeping that theme alive, we saw huge evidence of that, of course, this week with Bank of England pretty much communicating the fact that they're going to hike rates and perhaps not even hike rates just once. But as we look at the calendar this week, the major either confirmation or rejection of that thesis is going to come on Wednesday. Wednesday will be the marquee event for us as far as FX trading with the FOMC. Where's my FOMC here? Let me just get here for a second. Sorry, right over here with the FOMC rate decision. Now this is not a presser, but still the fact that they're going to issue a statement, market is going to be looking at that very carefully to see if they remain on track and committed. Remember, they have been basically saying that they really want to raise rates 25 basis points before the end of the year. And it'll be fascinating if they reaffirm that statement, even in the face of hurricanes, even in the face of relatively weak retail sales, even in the face of a lot of things that look like the U.S. economy is basically treading water at this point. I think the dominant factor here, and also in the face of generally, mute inflation. We actually last week, inflation did perk up just a tad bit. But overall, really, if you were to make a fundamental argument, there's very little fundamental argument here for the Fed to hike rates in December. But the much more important argument, and this is the argument that I think all the other central banks are making, is a policy argument. They don't care about fundamentals. What they want to do is be able to normalize policy so that when things do get difficult, when the economy does turn negative, they have the flexibility to lower rates. I know it sounds kind of absurd, but that is really the operating principle behind a lot of this tightening. Now, what that means as far as flows, what that means as far as trade is, of course, it creates massive resurgence of carry trade speculation, which is why you're seeing the yen crosses just blow up. I mean, we're going to talk about that in the crosses section, but the yen crosses was the trade this week because carry is back, baby. Carry is back with a vengeance. If everybody's going to move towards a tightening policy, and of course the BOJ is going to do nothing. Now the other big central bank event, of course, this week is the BOJ. BOJ really would be shocking if they came out with anything but a dovish statement. They still think that they need to monetize a huge amount of the economy at this point. They still don't see deflation. They're seeing a percolation of some inflationary impulses in the economy, but not enough for them to really put the move the foot off the pedal. They're still very much pedal to the floor, all out accommodative policy, and that's what makes the yen, despite all of this weakness in the U.S. dollar and the U.S. economy, the carry trade preference. Aside from that, we don't have that much major events. There is one interesting event. Now, this to me, I think, is going to be probably the most interesting economic event of the week, which is the retail sales. That is certainly going to be huge watch. I'll tell you why. The primary bearish argument against the UK economy is that, economy is doing okay, manufacturing is doing okay, service is doing okay, lower cable is certainly making UK businesses a lot more competitive in the world, so they're able to kind of function. But wages have not been growing well. And most importantly, inflation has been very high. So real wages, that is the actual amount of money that people make, has been negative for quite a long time. That in turn creates a very negative, depressing effect on retail sales, which is the primary reason why the Bank of England should not raise rates, right? That's sort of the bearish argument. So if we get a counter thesis to this, in a sense that if retail sales actually pop, if there is some life in the UK consumer despite all of these obstacles, that just really accelerates the idea that BOE is going to hike rates in November and pretty much catapults pound above that key 135 level. Aside from that, smattering of European data with Zeus survey, nothing much on there. U.S. data aside from the Fed really doesn't have any impact. And I'm looking here on Friday. I think these are all. Oh, no, these are preliminary. These are actually worth watching. These are going to be the preliminary data points. We'll have to see if the European economy continues to perform relatively well out of PMIs. But that's about it. That's really the big thing. And then if the calm dollars we'll cover in the calm dollar section. The key thing this week will be the Fed, and is the Fed still hawkish? That's going to be a big tell on the monetary policy, and on the economic data point, it'll be the retail sales in UK. Those are the two primary things that I'll be watching as far as trade opportunities. Now let's take a look at the charts here and just see how everything sets up on the majors. So you see Euro holding bid still. We're still holding bid. This is, I think, a kind of a very impressive move, because I really thought that we're going to break down the 1800. We haven't yet. However, when you look at this, we're basically still looking at a double top formation, still haven't really broken out. For Euro to maintain its present bullish trend, we need to see 21 or higher. We need to see fresh highs. If the longer we go with less fresh highs, the likelier it is we're going to see a more corrective move. And most importantly, if we break the 1800, that to me is the key support. We break the 1800, that really would confirm a near-term topping formation. It would have a more consolidative move, perhaps towards the 1600 as we go forward. Overall, still very much a long-term trend, but we are clearly losing momentum to the upside. And the only thing that really would make me bullish is if we took out the 21s. We really need to see that on a closing basis, not just take out 21s and come right back and retrace it, but really need to see 21s on a closing basis to make me super bullish Euro. I'm still sort of sell the rally Euro, or even sell here with a stop above these highs, assuming that we're going to test the 1800s as we go to the downside. Yen, very impressive comeback. Yen made a nice V-shaped bottom. Whenever yen makes these V-shaped bottoms, notice it goes both ways. If we have a V-shaped bottom, a V-shaped bottom is something where you just make a peak or make a trowel and then we just turn on a dime. That is meaningful. That's telling you here, as you can see, it's usually good sometimes for 500-600 points move. This is actually what, a 700-point move, right? 1450, about 600-point move. Then a 600-point move the other way. Then a 700-point move this way, and we're only 200 points move into this V-shaped formation. So if you sort of look at the analog here, yen could go. We took out the 110s. The 110 was a big resist point. We took out the 110s. We were now trading a little bit above, just below the 111s. As long as we can just take out, the key thing here is if we can take out the highs here around 1120 that we posted on Friday, we really have a very good shot of going to 112. 112 to 113 becomes a bigger resist point. But as I said, yen travels in V-shaped moves, and this is really if the Fed comes in and says, yeah, we're still on target to do a 25 basis point rate hike by December, that should be very positive dollar yen, which has been so grossly oversold, to push it to 12 to 1300 as we go up. This has been a pretty decent W bottom, and so far it remains on tap. What would completely change my mind to a negative formation is if we broke back below the 108s. That would be a very negative construct, and I would suggest that the market really, the bears are really dominating the move here. That actually, that would be a super dovish statement out of the Fed that would destroy a huge amount of technical formations. For now, though, you have to play it to the upside. That's what the technicals are telling you. It looks like we're going to be marching towards 12 to 1300 as we go forward. And of course, the Cinderella story of the week. Look at this massive breakout in the pound. This is a 400 or 500 point breakout in a matter of 2 days. Need to really go back. Let's look at the weeklies, because this really deserves a much deeper look. So this is Brexit. We took out the Brexit 35. Actually, let me put this into context. This really requires Just bear with me because this is so interesting. You guys really will appreciate this. Let's go back all the way up. We're going back like 20, 30 years. What is this 135 level? Look at this 135 level. That is 2001, financial crisis of 2008, 2009, and then Brexit. So you cannot tell me that this is not a massively important level in the British pound. So that acted as support for decades. Then it broke down after Brexit. That was just sort of the culmination of just how bad Brexit was for the currency. It went all the way down to 120, and now we're right back up. These are monthlies. I'm showing you the monthlies right now. Now we're above this 35. So to me, the critical factor in cable, whether this is a truly legitimate breakout, is if we can hold above 35. The longer we hold above 35, the more legitimate this becomes for a move towards 140. And it really could go to 140 if the BOE makes good on its promise to hike rates. Let's set Brexit aside for now. Let's just, for now, not worry about the impact of Brexit because, you know, it feels like they're going to dilly-dally for another year or two. It's going to come back and haunt them. This could all completely reverse. Fundamentally, there is, as I said, zero hope for the UK economy, but none of it matters now because we're trading right now strictly on interest rate flows. And if the BOE makes good on tightening, this becomes the fresh carry trade. Move's going to come in here, and market is going to believe falsely that everything is going to be okay, and cable is going to go to 140 easily. So right now, the trade is to the upside. Follow the flow. If it holds above 35, it becomes a very powerful, likely proposition to move all the way up to 140 over the next couple of weeks. So that's how the week shapes up. Should be fascinating trade off of big breakouts that we saw last week. Wish you guys the best of luck, the best trading. Boris, over and out.